On Monday, March 23rd, Apollo Global Management, one of the largest private capital firms on the planet, told its investors they couldn't have their money back.
Not all of it, not even half.
Their $15.1 billion debt fund received withdrawal requests for 11.2% of its assets. Apollo honored 5%. The rest? Denied. 24 hours later, Ares Management did the same thing. Their $10.7 billion fund, the Ares Strategic Income Fund, received $1.2 billion in redemption requests, 11.6%. They released $524 million, 43 cents on every dollar investors asked for. Then Blackstone's HPS fund, then Blue Owl Capital, then Cliffwater. 5 firms, 5 locked doors, 1 week. Now, if this were a bank, if Chase or Wells Fargo told depositors they could only withdraw 43 cents on the dollar, you'd call it a bank run. CNN would lead with it. The Treasury Secretary would be on camera by noon. But these aren't banks, they're private credit funds. And most people have never heard that term, even though nearly $3 trillion is sitting inside this market right now. So the question isn't whether private credit is in trouble. The gates already answered that. The question is, who is being lined up to absorb the damage next? To understand what just cracked, you need to see what built it, and why it was always going to crack. Rewind to 2008, the financial crisis. Banks had made catastrophic loans. Mortgages bundled into securities nobody understood, sold to investors who trusted the ratings. The system detonated. Lehman Brothers collapsed. AIG required a $182 billion government bailout. The entire banking sector came within hours of total failure. And then Washington did something that seemed reasonable at the time. They passed Dodd-Frank. They tightened Basel III capital requirements. They told banks, you cannot make those risky loans anymore. Hold more capital on your balance sheet. Lend less aggressively. Be safe. The banks complied. They had no choice. But the demand for those loans didn't evaporate. Companies that couldn't qualify for bank financing still needed capital. Mid-market firms, software startups burning cash, leveraged buyouts that needed debt to close. The borrowers were still there, hungry, willing to pay premium interest rates for the privilege of borrowing. So a shadow market formed. Private credit. Non-bank lenders, hedge funds, asset managers, private equity shops, stepped into the gap the banks left behind. They lent directly to companies, negotiated terms privately, set their own interest rates, performed their own due diligence, and told their investors, these loans are safe. Diversified, uncorrelated with public markets, low default rates. And for 15 years, the pitch held up. Institutional investors, pension funds, university endowments, sovereign wealth funds from Norway to Abu Dhabi poured money in. The market exploded. By 2025, it had passed $3 trillion globally, roughly 5 times what it was a decade earlier. Returns were strong. Default rates stayed stubbornly below 2%. The asset managers called it a zero-loss track record. That phrase, zero loss, showed up in marketing materials, investor decks, conference keynotes. It became the industry's identity. And nobody asked the obvious question. How do you lend $3 trillion to companies that banks won't touch and lose nothing? The answer, and this matters, is that you don't. You just don't report the losses the same way. There's no public exchange, no daily price, no outside auditor marking your book against market reality. When a borrower starts struggling, the lender doesn't have to write down the loan immediately. They can restructure it, extend the term, defer the payments, add the unpaid interest to the principal. On paper, the loan is still performing. In practice, the loss is hiding inside the structure, accumulating quietly, waiting for a catalyst to force it into the open. And then the cracks arrived. Morgan Stanley published a warning in early 2026. Default rates in private credit direct lending could surge to 8%. Not 2, not 4, 8. More than triple the historical average. The pressure is concentrated in one sector that should sound familiar if you've been paying attention: software. 40% of all private credit loans sit in software companies. The same sector getting dismantled by AI agents replacing per-seat subscriptions with 50-cent API calls. Those firms are bleeding customers, burning cash faster than projected, and struggling to service their debt. And the repayment games have gotten creative. A growing number of borrowers aren't even paying interest in cash anymore. They're using something called PIK, payment in kind, which means they pay their debt by issuing more debt. The lender doesn't receive money, they receive a promise of more money later, an IOU stacked on top of an IOU. The Financial Times recently found that private credit lenders had been understating their loss rates in marketing materials, in some cases, claiming losses lower than 0.1%. On loans to companies that can't pay interest in cash, the institutional investors, the pension managers, the endowment chiefs, the sovereign wealth analysts, they started seeing through the marks. They started pulling out. And that's when the gates came down. 5 firms, 1 week, 43 cents. But here's what nobody in the financial press is connecting to what happened next. While the institutional money was heading for the exits, somebody opened a new entrance. August 7th, 2025. President Trump signed an executive order. The exact title, and I want you to hear every word of it. Democratizing Access to Alternative Assets for 401k Investors. The order directs the Department of Labor to remove regulatory barriers preventing employer retirement plans from including private equity, private credit, real estate, and digital assets in their 401k investment lineups. The framing was clear, giving regular Americans the same opportunities as the wealthy, leveling the playing field, modernizing retirement. Sounds like progress, right? Now watch what happened in the months after that order was signed. April 2025. State Street launches target date retirement funds with built-in private market exposure. May. Empower, the second-largest 401k provider in the country, announces partnerships with private investment fund managers. July. Goldman Sachs launches the Goldman Sachs Collective Trust Private Credit Fund. October. Blackstone creates an entirely new division focused specifically on developing investment products for retirement accounts. Apollo CEO Mark Rowan went on the record arguing that retirement investors can no longer rely on public markets alone. Morningstar, one of the most respected names in investment research, published their assessment of what was driving this push. Their words: "The push is almost entirely coming from asset managers, who see an untapped $12.5 trillion defined contribution market on one side and decreasing funding rates on the institutional side." Read that sentence one more time. Untapped market on one side, decreasing funding on the other. The institutional money is leaving, and the $12.5 trillion sitting in 90 million Americans' 401k accounts is being positioned, structurally, legally, operationally, as the replacement capital. The democratization is an opportunity. It's a capital substitution. You're not being invited to the table. You're being seated in the chair that just went cold, because the person sitting in it saw the plates being cleared and left before the check arrived. Now that you know who is behind this and what the play is, you need to understand how the risk actually reaches your retirement account. Because it's not obvious. You won't log into your 401k and see a line item that says, "Private credit, high risk, withdrawal gates may apply." It works through 3 layers, each one quieter than the last. First, the liquidity illusion. Private credit funds market themselves as semi-liquid. They promise quarterly redemption windows, Your money isn't locked forever. You can request a withdrawal every 90 days. That sounds flexible, until you understand what quarterly cap means in practice. Ares' fund has a structural ceiling of 5% per quarter. So when 11.6% of investors wanted out at the same time, which is exactly what happened last week, they got 43% of what they asked for. And the rest? Wait. Another quarter. Maybe two. Maybe longer. The liquidity exists only when nobody needs it. The moment real stress arrives, defaults rising, valuations uncertain, markets tightening, the gates slam. You're holding an asset that was sold as flexible, but behaves like a trap door with the lock on the wrong side. Second, valuation opacity. When you own an S&P 500 index fund, the price updates every second. Supply and demand, transparent, verifiable. In private credit, there is no market price. The fund manager decides what the underlying loans are worth. They mark their own homework. Unlike 2008, when an accounting rule called FAS 157 forced banks to mark assets to market in real time, which accelerated the crash, private credit operates without that rule. A fund can report stable NAV on your 401k statement, while the loans underneath are rotting. Nobody outside the fund can verify the marks until the damage is already done. Third, target date fund embedding. You will probably never choose private credit directly. No checkbox, no pop-up. Instead, it gets woven into the alternative allocation sleeve of your target date fund, the same fund your employer auto-selected for you when you were hired. Goldman already built the product. Blackstone already built the team. Regulatory proposed rules were due by February 2026. Final rules by late 2026. Empower is already partnering with private investment managers to pipe these products through. Your exposure will arrive through the same default architecture that enrolled you in the 401k in the first place. You didn't actively choose the target date fund. Your employer chose it for you. And now, that fund's managers can choose to add private credit for you. No separate notification, no consent form, no warning about gates. And the irony is brutal. The same behavioral design that made 401k auto-enrollment one of the most successful retirement policies in American history. The insight that people don't change defaults, so make the default a good one, is now the delivery vehicle for an asset class where the exit doors lock. Here's the part that should bother you most. You probably can't tell whether you're already exposed. Your 401k provider's website has a fact sheet for every fund in your lineup. Open the one for your target date fund. Search that document for alternative investments, private credit, illiquid allocation, interval fund, or non-traded. If any of those terms appear, you're already inside the structure we just described. Most plans haven't added private credit yet, but Yet is doing a lot of structural work given what Goldman, Blackstone, and Empower are building right now. And if you're close to retirement, the math changes completely. A 28-year-old can ride out a gating event. A 55-year-old cannot. If a private credit crunch hits the year you plan to stop working, the gate doesn't check your calendar. It fires based on market stress. You wait, with 43 cents on the dollar. The distance between you and your retirement date is the only variable that turns this from an abstract risk into a structural threat. But the bigger takeaway isn't about private credit specifically. It's a diagnostic you can carry with you. Anytime a financial product that was previously restricted to institutions suddenly becomes available to retail investors, ask one question. Not what's inside. Ask, why are the current holders leaving? If institutional capital is flowing in and retail access opens, that might genuinely be democratization. The pie expanding. More chairs at a growing table. But if institutional capital is flowing out and retail access opens at the same time, the architecture is risk transfer. You're not joining the winners. You're replacing the people who just realized they were losing. We showed you how private equity guts your local vet clinic and sells it to the next buyer before the walls cave in. Same playbook, different scale. The extraction ran through your neighborhood first. Now, it's running through your retirement account. And remember, the software companies those private credit funds lent to, the ones that can't service their debt because AI agents are replacing their per-seat subscriptions, that's the same structural collapse we covered when the SaaS model died. These stories aren't separate. They're load-bearing walls in the same building. Pull one out, and the stress transfers to the next.
The door opened for you this week. Ask yourself why.